Welcome, everyone, to the Directed IRA podcast with Matt Sorensen and Mark Kohler. We're delighted to be with you once again.
Yes.
For another amazing episode.
Yep. I've got my Rockstar Recovery here. Again,
Okay.
folks, this is no sugar, no carbonation, 10 calories, and 160 grams of pure love. That'll get you through the hard days when you're thinking about, how do I self-direct my IRA? In fact, how would I flip a property inside my IRA?
Yeah, can I even do that?
Yeah.
Well,
Pick up a Rockstar.
pick up a Rockstar.
Listen to this podcast.
Here we go. We're going to open that can. Yes, you can do it. But there's some things you need to know. And so we've had thousands of clients over the years use their IRA to buy a piece of property, rehab it, flip it for profit. All that money goes back into the retirement account, no tax. Pretty cool strategy. So it's a little different, though, than a rental, which we've talked about on the show more extensively, just buying the rental with your IRA. It's a little more things you need to know about flipping a property with the IRA.
Yeah. And Matt Sorensen, I've got a good example to use too. I was thinking I could bring up that Rigby property.
Yeah.
That's really evolved. It started out as a flip, and to kind of pique everybody's interest, here's the question. See if you can answer this on your own. What is the fallback position for a flip gone bad? It is a rental property. If any of you got that, go ahead and reward yourself with a junior mint. Yeah. So the point is, whenever you're analyzing a flip, I think Matt, to me, there's really two topics going on here. First, how do I be smart about a flip? And then number two, how can I do it inside an IRA? And so some of you might be a little frustrated, like, well, hold it. You guys are consulting clients every day on flips. Probably have some fairly good insights on that. I would hope so. But really, we're going to focus on the financial piece of this. What's the transaction on how to do it? But I think knowing that it could turn into a rental is one aspect that really permeates both sides of the aisle.
Yeah.
Did you like that? Permeates?
Yeah, you got to nail both sides here to do a good flip. You got to nail the retirement account side, and you got to nail the deal, just in of itself. So we'll go through some of the things we've seen over the years that people do well, and also some of the pitfalls and landmines you can step on if you're not being careful.
Yeah. Oh, I've got a quote that I'm going to extrapolate from the famous Matt Sorensen. You ready?
Okay.
This is a quote that Matt Sorensen, I'm going to try to do this in, proxy for you, Matt.
Okay. Let's see. I'll judge.
Okay. Let me see. A good contract makes a good deal better. A bad contract makes a good deal bad. I didn't get it, did I?
Yeah. Something like that.
Come on, clean it up. Clean it up. What is it? A good deal, a bad contract makes a, what is it?
Yeah. Well, a bad contract makes a good deal a bad deal.
Yeah.
Like if you think about it from a contractual standpoint, this is happening a lot right now. It's a highly competitive real estate market. And if you've got a bad contract, you've got a bad deal. You may have negotiated the greatest terms in the world on the purchase,
and it's a good project.
And it's an amazing project. But if your contract sucks, that deal is not going to go well.
Okay. Now,
because if you've negotiated hard and you've got a good deal on your side, eventually the other side realizes that at some point. Yeah. Sometimes that happens. And your bad contract you were sloppy with just killed your deal.
I love it. Now, here's why I'm excited here. Trying to jump in here is tell you, well, let's extrapolate that to today's topic. A bad IRA approach can make a good project bad. So if you don't go in with the right IRA funding and the right structure with your IRA, you could have a great project and it goes bad. So you want to make sure you're nailing the IRA structure. What do you think? Did I bring that around?
I like that. Yeah.
All right.
You got to bring the right tools to the job. All right.
Okay.
And it's a different set of tools that you want to use when you take your IRA out to go do a deal than it's just Mark Kohler personally flipping a property. Yeah. Okay. It's a little different tool set. And so we need to make sure we understand how to use those tools. The IRA, of course, being the the key one here. So
Okay.
let's get into it though, if you don't mind.
Yeah, no, I've got an idea. Should we start with an example? Like I could throw out the Rigby example, and then we build upon that with how the IRA transaction could or look or grow from? Or should we just start with the fundamentals of a transaction?
Let's do a basic, easy one, because that one's got a little more partner issues in it. Let's use that as kind of like next level.
Okay,
almost.
all right. So first level, okay, you go ahead. Do you want to use an example or just say this is how you do it?
Let's just give the plain vanilla easy example of I want my IRA. I've got cash in my IRA and I want to go buy a property, rehab it, and flip it, and all the gains go back into my IRA. Okay.
All right, let me ask you a question. Are you going to have debt?
Nope.
No debt.
Not on this one. Next level we will. We'll talk about that, but not on this.
All right. On this level, I got enough cash in my IRA or 401k.
Yep.
Okay. To buy it, fix it up, and flip it. Okay.
Yep.
Can I do the work myself, Matt?
No, you cannot work on the property.
Damn
so
it.
that's that's actually good for the deal. You don't want Mark Kohler swinging a hammer on a
No,
property.
that's true. Okay. So
It's actually a good rule. But any of you, even if you may be handy and maybe you're even a contractor, you can't do it. And that's one thing on a flip that's unique is you can't do physical work on the property. You can go to the property, tell contractors what to do, determine what rehab and things you want to do, pay them from the IRA, but you physically can't be swinging the hammer doing the work.
And any good property owner goes down and wreaks havoc on their contractor. I mean, this is one of the pleasures of life. So
That's right.
let's go down there and start yelling at people. Your contractor will love it.
Yeah.
Okay. Now, next question. Do I need an LLC to do it?
You don't need one, but you're going to want one. You don't have to, but you're probably going to want one.
Okay.
Now that LLC, called an Ira Llc or checkbook IRA, by the way, if you're not familiar with that, go back to the first 5 to 10 episodes. We break this down because what you're going to need, by the way, when you start this is if you're not familiar with even what the heck a self-directed IRA is, your money's all at Fidelity in an IRA. Well, Fidelity is not going to let your IRA buy and flip a property. So the first thing you're going to need to do is move that IRA at Fidelity to a custodian like Directed IRA, our company, where we let you buy real estate, a rental, a flip, buy crypto, invest in a startup, a small business. All that stuff's a cool asset we'll let you own in your IRA.
I like it. You slowed me down. That was good. So we step back and go, my IRA could be at a normal brokerage or a ridiculous brokerage. And I want to say, okay, I want to do a flip. I got to move it first. And I like what you said that technically, I could call Directed IRA and go, hey, I want to do this flip. Buy the property, and I'm going to send you an invoice every week for someone that freaking mowed the lawn or did drywall or whatever.
Yeah.
And that's not going to be fun. That's where the LLC comes in probably.
Yeah. Only one I've seen with that is like they had a general contractor that they just did kind of like bi-weekly draws or, and so it's like, all right. And the general was paying all the subs. And so that's possible. But when your IRA owns it, remember your IRA is on title. Your IRA gets the income. Your IRA gets the rent or the gain when you sell it. But your IRA has to pay all the expenses too. So when I got a sub over there wanting to, install cabinets and I got to go buy the cabinets and then pay the contractor for the work, calling my IRA custodian and authorizing a payment to that cabinet person by a wire or check is just kind of not how you do it in the rehab world. So it can be a little clunky by having the IRA directly own it.
Okay. So step 1, meaning you roll your IRA over or 401k, whatever you got. Maybe you have a solo 401k, or a SEP or whatever you got. So you get it to a Directed IRA position or structure, and then you say, okay, I'm going to open an LLC. Please listen to our prior podcasts on that. I call up Directed IRA on step 3 and go, hey, fund my LLC. I'm going to need X dollars. And then they move the money into your LLC. Now you've got a checkbook. And can you write the checks?
Yeah. So now the IRA owns that LLC 100%. You don't own it. IRA does, but you're manager of the LLC. And as manager of the LLC, you can sign the checks. You can also sign the contract to purchase. So when you buy the property, the contract to purchase is going to be in the name of the LLC. On the deed to the property, it's the name of the LLC. And then you're cutting checks to the contractors, the subs. You can have a debit card on the LLC bank account if you got to buy fixtures or whatever. This stuff just comes up. You're all in control. And that's why a lot of people call it a checkbook control IRA. We call it an IRA LLC. But you're in control to pay people to get the work done without having to go back and forth with your custodian, us, which we love you, but we want it to be efficient for both of us. So the LLC is a great option.
And I know some of you out there that have maybe been in the self-directed IRA industry for a few years, and you've kind of researched this a little. Maybe you've called your custodian about this, or been to a Thursday night workshop at your RIA club, and you've heard about this. Let me dispel a couple crappy myths that are lies out there. Some custodians will say, you can't be the manager of the LLC. Bullcrap. That's their rule internally because they don't have good tax lawyers inside their custodian or trust company helping direct them on what can actually be done. Luckily, we have the author of those on YouTube. I'm holding up now a crisp copy of the Self-Directed IRA Handbook. This is second edition, best-selling book in the country on self-directing, written by my amazing co-host, Matt Sorensen. You can send a check later over to my office, Matt, for that. Okay, now, with that point that I'm making, though, you can be the manager of the LLC. You just can't be swinging a hammer. So don't listen to anybody if they tell you otherwise. They're full of crap. Now, a couple other prohibited transactions. I'll throw this out, Matt. And I think everybody, you've got to listen to the podcast on prohibited transactions. This is a rabbit hole, but just in in the fix and flip context, I think we do need to address the fact you can't work on the property. Could I hire my S corporation to do the work? It's not me. I'm not going to go do the work. I'm going to hire my S corp. Can I do that?
Nope. Nor your spouse's S corp or your kid's S corp or your kid. So now
Notice
your brother.
How I'm the good cop in the show, and Matt's the bad cop.
You always set me up for the no answers. And Mark's like, but there's a solution. He always wants to be that guy. Sometimes we go into meetings and do the good cop, bad cop routine, and guess who's always bad cop? I mean, so I think that the other one that's important to note, though, too, is with the Ira Llc, you don't get to pay yourself to be a manager. You don't get a commission if you're an agent, So you just can't personally make money. Just remember, this is your retirement account. Let it make the money on the deal. You're not trying to suck out money to pay yourself personally. Those things are prohibited under the rules. You can't work on it. You can't pay your own companies or your spouse or kids. These are prohibited under the rules. So, but sure, I can buy the property from a third party. I can hire other contractors to work on it that are not prohibited to me, which is pretty much every other third party or more distant family members. Okay. And then you're going to have a point where you come to sell the property too, which also you can't sell it to yourself. You're going to sell it to a third party buyer, of course.
Okay. Now, one thing that I think we need to address too, and so I'm going to say, chill out, all of you fix and flip professionals out there, because by now on the podcast, you're like, I'm just going to turn this off. Whoa. We've got, we're at stage one. Well, I think a lot of them feel like they want to turn this off because they say, well, I make money on my fix and flip because I'm the one doing the work. And, of course, and so we get that. But here's our point. Let's think technically. You might create 10 or 20% equity in a project by cutting out a general contractor. I get that. You hire the subs, you have a couple specialties yourself, and I'm not saying you can't go in and make decisions about decorating and staging and paint colors, do all that. But just be careful. You've got to be able to show the IRS under an audit that you actually paid someone to do the wallpaper. You paid someone to do the painting. If there's not a receipt for that, they're going to go, who the hell did it? So, but the point what I'm getting at is I know that your fix and flip projects are 20% more profitable because you cut out a general. So you're going to say, this is dumb. I'm not going to do it. Now hold it. But the beauty of this is you cut out the tax in this situation, which could be far more than 20%. So that's the give and take. Yes, you're going to have to hire a general or pay more for some workers. So that's going to drive up your cost in the fix and flip. But just be waiting for the back end, baby, because you're not going to pay any tax on the back end. And we're going to come to some situations where you might. But for the most part, you can avoid the tax. So that's the payoff on the back end. So don't get your underwear in a bind and go, well, this is dumb. I need to do the work because that's how I make them profitable. No. You can still make them profitable. Find someone else that you typically may partner with. Pay them to do it,
Yeah. And any person fix and flipping at scale is doing that anyways. I mean, they got other people they're paying they're doing multiple projects. You can't be everywhere at every project anyways. And if you're a successful fix and flipper, you're not hanging the freaking drywall. Okay. And if you want to take it to the next level, you shouldn't be doing that anyways. I'll just say that. Spend your time running deals, managing, finding, and making money. So, but also just keep in mind, we're not saying don't do flips personally, do them in your IRA. I'm just saying if you figured out how to make money flipping properties and that's a good little business for you and that's your thing, I'm just saying stop buying mutual funds with your retirement account that you don't know what the heck they are. Use your retirement account to flip as well and build that long-term wealth. Let's invest the money you already have in the stuff to grow that retirement account for the long haul, for your long-term wealth, for when you hit 59 and a half, where you can just go into cruise control and live off that big fat retirement you built up flipping houses over the years.
I love it. I'm going to say it a different way because usually the way I say it makes more sense. Oh, was that my inside voice? I'm sorry. I'm sorry. That slipped out.
Yeah. We'll judge if it makes more sense. I mean,
okay.
Here's what I'd say. Good what I just said, but
I like what Matt said when he said, we're not saying don't do fix and flips. We're saying do them both in your own name and your IRA. And what I would say is you can cherry pick. If you're good at this and you've kind of figured it out, the fix and flips where they're going to be kind of a pain. There's some unique repair. There's a unique rehab to it where you're going to need to be on site. But when you see that slam dunk flip and they come around once in a while, don't do it. Don't do it. Let your IRA do it.
Exactly.
Helps everyone. Hurts no one. Helps the economy.
Good for the economy. And I think your IRA, for the most successful clients over here in real estate, use their IRA to do the same stuff they do personally. Yeah. And they find the right deals that make sense in their IRA, just like you said, that are a little more cleaner and easier. Frankly, a lot of our Roth clients put the best deals they come across into their Roth because they know it comes out tax-free. But they got enough deal flow to do the next deal that comes along personally. And you know what? You can't do a lot of flips with your IRA. There's a couple limitations to that. One, how much money do you have in your account? Can you do that many flips with it? The second would be there is a tax that you should know about on flips called UBIT, Unrelated Business Income Tax, that basically says if your IRA is in the business of flipping real estate as opposed to investing, your IRA has to start paying a tax on its profits called UBIT, which is 37%. So if I'm doing a lot of flips with my IRA every year, and I just transition to flipping everything in my IRA, which we're not saying that. But if you're doing too many flips, your IRA will pay this UBIT tax. Now, our rule of thumb has always been, if you're doing one or two, don't worry about this UBIT tax. Your IRA is just investing and flipping property. If you're doing 3 or 4, you're in a gray area. 5 or more, that's enough flips where the IRS could look at your IRA and say, your IRA flipped 5 properties in a year. We don't think that's investing in real estate. We think that's the business of real estate. And they want to assess that tax to your IRA now. So hope that helps just on volume of deals.
Wow. Very well said, Mr. Sorensen. Yeah. I don't think I could say that any better.
You can't.
Okay. Well, enough said then. Okay, but I was going to say
that's the first thing you said I've agreed with all show.
Now, I will say this. I think what Matt just brought up is level 2. Okay, now people, I'm glad you're still here. If you're still listening, we have a lot more to share on this. We just did level 1 basic. Remember, your IRA set up an LLC, a freaking bought a property, it paid someone to do the work. Maybe it took 4, 5, 6 months. You sold it, you made some money. Okay, level 2 is, how many of these do I really want to do? And as Matt said, I think our comfort level is, if you can knock out 3 a year in your IRA, don't do any more than that. And frankly, doing 3 flips a year, that's a lot of work. It really is. If you haven't, anybody that's done flips is like, that's pretty ambitious. And you're like, well, I do that number because I have a crew. Well, sorry, you can't use your crew. You're going to have to sub it out, to someone.
Unless they're 1099 people, which a lot of people do. It's like, well, this is my crew. They're just my subs I use on all my deals. That's okay. That's your crew, but not your W-2 people crew.
Yeah, not your W-2 crew. Okay, now let's go
Now,
level
can I give a tip though? Because this isn't a couple of options I want to throw out. One is, let's say you've already done 2 a year. Well, has your spouse? Because your spouse could do 2 flips a year in their retirement account, and I get the clients that are they're going to throw as many in they can do. Oh, does your kids Roth? Can they do some? And even people who are doing wholesaling, by the way, a wholesale is essentially like a flip under the rules for retirement accounts. You're not even rehabbing the property. You're just going to property under contract and wholesaling the contract or assigning the contract for profit. That's cool too. You can do 1 or 2 of those a year in your IRA without any UBIT. So could your spouses. So could your kids Roth. I mean, I have clients that do 2 wholesales a year in their Roth IRA, 2 wholesales a year in their solo K, 2 wholesales a year in their spouse's Roth, the 2 wholesales a year in their kids Roth. You know what I mean? And they're like, wow, I could actually wholesale 12 properties in a year. And they just have the deal flow. So they're doing it and no UBIT, because those are all separate accounts that can each do a couple of deals with no UBIT.
You said Kid Rock's doing them in his?
Yeah, even Kid Rock is doing this. That's Kid Roth. That's
Kid Roth with the TH.
Yeah.
Okay.
Yeah.
And I'm a fan of Kid Rock. So, by the way, he does a lot of philanthropy. He is a great guy. We should have him on the show.
We should.
Kid Rock versus Kid Roth.
Yeah.
What's the difference?
Both cool things.
Yes, both cool. Okay, now let's go level 3. Okay, here's level 3 where I think we start turning the corner. I want to use debt. Now, a lot of fix and flippers, especially early on, have to use hard money to fund the rehab, or maybe a first mortgage, kind of some bridge financing, personal lender, private lender, whatever the one you want to call it. There's probably 5 different places generally you could go find money to pay for the rehab. Can your IRA do that, Matt Sorensen?
Yeah, good. You could get a loan. The IRA, I should say, could get a loan for a purchase and rehab, or just one of the two. And there's 2 things you need to know though for that. One is that loan has to be non-recourse. Your IRA or your Ira Llc, more likely what you're using here, would be the borrower on the loan. And the lender would agree, hey, in the event of default, I'm going to foreclose and just take the property back. I won't come after the LLC or you personally or the IRA. The only recourse for me as the lender here is to foreclose and take the property back. Now, when you're buying,
did you say y'all?
What's that?
Did you say y'all? I'm not going to have to come after y'all's.
Did I?
I was impressed. I mean,
that could have slipped. I mean, I did get a cowboy hat for my birthday this year, so
you've been
just
watching Yellowstone.
Yeah, I did watch Yellowstone. So
okay, I'm gonna give you a pass on that because I think that's very justifiable. So I borrow money with my IRA to do this rehab, and they can't come after y'all's assets because you did not personally guarantee it. They can just come after the property, which is cool.
I think what I said was your IRA's assets.
Well, but it's non-recourse, meaning you can't sign on it, so they're not going to come after you.
Exactly.
Yeah, there's no.
And so the private money lender, this is one thing you need to make sure, because a lot of times if you're working with a hard money lender, when they loan to an LLC, they're like, you got to personally guarantee it. No. You're going to need to find the private money lender that does not make you guarantee it. And there's plenty of them out there, by the way. Plenty of other people's IRAs that lend to other people who have their own IRA buying and flipping the property. Yeah. So you generally have to have some money down on the property, some skin in the game for the hard money lender to feel comfortable with no personal guarantee. But that's fine. The IRA throws in some cash and somebody finances the balance on a hard money loan to finish the purchase and rehab. Great option. Okay, so it had to be non-recourse. That was the first thing.
Oh, you got a second. Jeez. Okay. Pray tell.
Well, write your congressman. I don't like the second one, but it's out there and you need to know about it. All right.
Now, you be the bad guy and tell him about the second, and I'll tell him the way around it. Let's get back to our normal plan.
That's how the show works. Okay. So
break the bad news.
There's another tax. It's another 4-letter word, UDFI, unrelated debt financed income. This is a debt that applies to IRAs when they get debt to purchase an asset. So basically what the IRS says is, oh, you want to buy a property for $100,000, but you're only going to put down $20,000 from the IRA, and a hard money lender is going to lend the other 80% to buy and rehab the property. The IRS looks at that and says, 80% of that deal wasn't retirement account funds, so we're going to tax 80% of the profits on the deal. So this is called UDFI. So when you bring in debt for an IRA, on real estate here, you run into this tax issue. Now, it's not the end of the world. You get capital gains rates when you sell the property, short or long term, depending on how you held it. And you only pay tax on the debt piece of the deal. And a lot of clients only have to hit it their first few years and deal with it. Then they have enough cash in the account to just buy the properties outright. And this doesn't end up becoming an issue.
And that's normal for a regular fix and flipper too. I mean, the bane of their existence is hard money, but it's kind of a necessary evil until you get your own pot of gold going enough where you don't have to call that hard money. I know so many fix and flippers, the day they throw away their hard money lender's phone number is a happy day. And that's cool. Now, let me give you the good news, folks. Now, this is a high-end strategy that we have, Matt's written about it in his book. He called and consulted with me on it before he wrote that chapter.
Yeah.
I really guided him through it, to be honest. Now everybody listen, this is a big deal.
I don't remember, but it could be true.
Yeah, it could be.
Yeah.
No, it's not.
Could be.
No, it's not. Veronica Vaughn, no, you didn't. Okay, now here's the deal. Everybody listen, quit multitasking. If you're going to fix and flip and use debt, do not do it in an IRA. Do it inside your solo 401k. Now, this actually happens to be a fairly common strategy of our fix and flippers because they're using an S corp for their flips. They don't want employees. They've got a solo 401k because they sub out all the work they can. And to have a solo 401k is very, very affordable, simple, and easy. And UDFI does not apply in a solo 401k, but it still can set up LLCs and still fix and flip, just like an IRA. So our more, I'd say, mature, I don't want to say mature or advanced, more seasoned? What do we call our IRA investors that are a little more experienced?
More experienced?
Okay. Our more experienced IRA investors, they really graduate to the self-directed
savvy,
IRA,
maybe.
the self-directed 401k.
Yeah, and the solo K is great because a lot of people that do fix and flip, just like Mark said, even if it's like your side hustle, you got a day job, 401k, but it's like, oh, I got my side hustle. I flip some properties here and there personally. Great. Open a solo K in that business and that solo K, whole separate podcast episode diving into why that's cool for other reasons. But here, that solo 401k could own and flip its own properties, and you're building up your 401k, your solo 401k, and it has no UDFI on leveraged real estate. It gets an exemption for this that IRAs don't get. So it's a cool strategy to know. Not everyone can do a solo K, but many in the flip space, for the reasons we outlined, it's an option for them.
Yeah. Okay.
I got another solution too, by the way.
Oh, well.
Yeah.
Is it have the word blocker in it?
Nope.
Oh.
Let's say, let's say that you can't do a solo K.
Okay.
Maybe you have a business, but you got employees, so you can't qualify for the solo, or maybe you just don't have any small business. Like you just want to flip with the retirement account. There's no way to do a small business to justify a solo K.
Okay.
Now, I've done this with a number of clients, actually. Rather than get debt on the project, find some little joint venture. Debt coming in on the deal.
Okay. Hold it. Stay there, Matt. If you can hear me, Matt, we've got some, you're freezing up on us.
Testing.
I don't know if it's your end or ours.
Testing.
There we
go. It happened earlier when you were talking, but I just waited okay, sorry.
Well, since he's
so let me back up.
Okay, so you said, let's say you've got, you can't find debt. What did you say? Let's say you don't have debt on the deal.
Well, no, I'm saying let's say you can't use a solo K. So let me back up to that.
Okay. I think if you say, let's say you can't use a solo K, start with that phrase and then go.
All right. Let's say you can't use a solo K. Okay. It's just not an option for you. You got employees in your business, or you don't have any self-employment that justifies doing a solo K. But you got retirement account dollars and you want to flip a property. Rather than bringing debt in on the deal, bring in a joint venture partner, bring in some equity dollars. Now there's no debt on the book, so there's no UDFI to calculate. I have a client that's done this with their LLC and that their IRA owns. It's a Roth IRA. And he knows a lot of people that like to invest and put debt on his deals. But on these ones with his Roth IRA, he makes them a joint venture partner. His Ira Llc does a joint venture agreement with them, agrees to give them a little share of the profits. It's a small piece of profits, but then pays them kind of a fixed return that would somewhat represent debt and what they'd get. Now, that investor loves it because they're getting a little equity play on it too. They put in the cash that was needed to do the deal, and the client goes in without any debt on the books of the investment.
Now, a couple thoughts. This is actually a topic that I've covered prolifically. Now, I've covered extensively. That's the word. Okay. I've covered this extensively in a couple of my books and some blogs myself. Joint ventures sound so easy. Oh my gosh. They sound so simple. I'm just going to JV with this person and they're going to bring money to the deal. Blah, blah, blah. Just keep in mind that that process has its own little checklist of concerns. I'll just quickly say, and I love Matt's idea. It's wonderful. You may even, if you're, and I'm going to give you a way out here too, but let's say you're going to just do a one-off deal joint venture. Keep in mind that under legal principles, that is a general partnership. So if anything goes wrong on the project, you got an LLC. You're fine. You're 2 steps away. It's your Roth. It's your LLC. Blah, blah, blah.
Always, if you're doing the joint venture and the client I do, they are always using an LLC on their side that owns the deal and it's JVing with someone else. Yeah.
Now the someone else, if they say, "Oh, I'll JV with you," and they come in on the JV personally, you may want to do them a solid and say, if this goes, sideways, not saying it ever will, and you hate having that conversation, they're personally liable. Because it's a general partnership, general and vicarious liability for an individual on a JV. So do your JV partner a solid and say, let's get you an entity, call up KKOS lawyers, let's get that in place. The next point is a JV agreement usually implies you're going to 1099 NEC, Nancy Echo Charlie. And when you do that, a 1099, you can't call it interest. You can't do a JV and say, well, I'm going to pay you interest. If it's over and above an average interest rate, the IRS is going to get pissed. They're going to say, whoa, you can't call this interest.
Yeah. Now, that we don't want to. We don't want to anyways in this example because we don't want it to be debt.
Yeah, that's right. That implies debt. And your JV partner is going to have an audit issue getting excessive, quote unquote, interest when really it was a partnership. Also, they could have a self-employment tax or an ordinary tax problem. This is not going to be possibly short-term capital gain. It depends on whatever else is going on in their life and how many of these deals you're doing. So be careful of the JV. I'm going to give you another option. And if you're going to do regular, like say I'm going to call Matt up and go, hey, will you be my JV partner on this deal? And he goes, yeah, but I only want to do one. And I say, that's cool. I only want to do one with you too. A JV agreement could be a good fit. But if all of a sudden we find out that this is the best next thing to slice bread and we have this love affair and from a JV relationship, and we say, let's keep doing deals together, just form a freaking LLC. Don't go down the JV path. Just call us up, do a joint LLC. It's got operating agreements. It's got liability protection. You'll do a 1065. You get around all this tax crap, and a JV agreement is maybe 2 to 3 pages. It leaves a lot of option or open-ended issues. So anyway.
Yeah. The one thing on the LLC you got to be careful on is if your IRA owns this LLC, I want to set up the LLC to begin with that your IRA owns 100%. And I want you to go get that deal under contract. Then I want you to bring in this other partner who's going to be a equity partner in the LLC with you, but is going to get much less profit for how much cash they put in than what your IRA put in at the beginning. We can't put you guys all at the beginning and be like, well, your IRA put in, $50,000 on the deal and their IRA put in $400,000 and you're 50-50. It's like, that ain't going to work.
No.
But if your IRA comes in and puts in $50,000, and then a couple months later after you get the property under contract and now there's a deal that has value and they come in and pay 5-10 times that for half the ownership, that can work. And this is some of the stuff we talk about, by the way, at the Self-Directed IRA Summit. I have one of our clients that's going to go over a 7-figure deal, basically one of these JV deals on how he got around UDFI with his Roth IRA on some commercial deals. It was pretty cool. And we'll go over some other strategies we've seen. So this is kind of where the magic happens, I guess, where there's some things and some roadblocks you get, but if you know some solutions, a lot of times there's a way to work around it and avoid some of these tax traps that can still get you a tax deferred or tax-free deal with your IRA.
Yeah, and I think this is not a shameless plug. This is really a helpful plug because the summit, you get a chance to network with others, hear real, there's going to be people with multi-million-dollar Roths in the room sharing strategies. In fact, some of them said, I don't want this recorded. And that's how cool this is going to be. You're going to have a neat opportunity. And this is not going to be a virtual broadcast either. So if you want to come, it's mid-October. It's in Phoenix, Arizona. Get on any of our websites and you can sign up and get there.
Yeah, sdirasummit.com.
That's where you'll end up. So sdirasummit.com. Now, I want to give an example. Okay, I think it's time for Rigby. May I?
Okay. Yep.
Okay.
Yep.
Now, this is a fun example because I think it brings in a variety of issues, and it's not a 7-figure deal, but it's profitable. And I think it was a good example of all the variations you need to consider. Okay, so I've got this client. Oh, by the way, Rigby is a little town in Idaho. Think of it like freaking a little 20,000 person town, not even 20, it's probably 10,000 people town anywhere in Main Street, America. Great little town. Mm-hmm. And in a lot of these little towns, there's rehabbing going on because there's homes that are 50 to 100 years old, and there's some opportunities. So this is a couple years ago. This client of mine was like, hey, I got an IRA. Let's say, I'm not going to give generally a figure. I'll give you generally exact figures. So he's like, I got an IRA with about 120 grand. And my son was kind of in the real estate market, and he was seeing if this was a fit for him in his career. And I introduced them to each other, and they said, let's do it. And I said, hey, this is not my deal. This is my son and you. You guys want to talk? Go for it. So he said, yeah, I'll throw in my $120,000 IRA. Dylan had found a project that looked pretty profitable. And Dylan said, okay, for 20%, I will manage it, supervise it, and be the boots on the ground. If I do any labor, I want to get paid right alongside everybody else at $15 an hour or more. But I'll manage it. And he's like, sounds good. So they set up an LLC about 80-20. Well, the project cost about 90. So the building was 90, and they thought we'll put in 20 to 30,000, which is about what his IRA was, and we'll flip this thing for maybe 160. That was the original goal. Well, there's good and bad that always occurs in a fix and flip. They quickly realized first that it was going to take a little more than 30 grand. So they went into a lending situation, and they said, hey, Mark, Dad, now this is a good story. They go, hey, will you lend us some money? We don't know how much we're going to need. We're going to open a credit line with you. Maybe it'll be 10 grand. Maybe it'll be 30 grand. Will you be a lender on this? Now, the property was free and clear. So I said, sure, I'll be a first position lien holder. So I know I'm going to get my money back no matter what if this thing tanks, because I'm in first position. So my client was like, yep, I'm good with that. Dylan's like, please, that'd be great. We need it. And I said, okay, here's an interest rate. Now, Matt, hold it. There's an IRA involved. Can I lend money to this project?
Yeah. Well, it's not your son's IRA, so it's cool. And your IRA is not in there. It's the other third party.
Now, everybody, let that sink in. Because see, when we were earlier saying, well, you can't borrow from so-and-so to so-and-so, you have to look from the relationship from the IRA owner.
Yeah. And here's another thing. You might be listening to this podcast. You're like, oh, I fix and flip properties all the time. Guys, I'm just not sold on doing it with my IRA. I want to just make money today and spend it. And I just want to, make all this money today. Okay. Well, who can fund all your deals? Other people's IRAs. There's $35 trillion in retirement accounts out there. There's a lot of people who have a little sliver of that, obviously, that could invest in your deals, just like Mark's talking about here. Yeah, some other person's IRA that came in to fund the purchase and initial rehab expenses.
Ooh,
that's awesome. Subplot. That's a great way to fund your deals.
Yeah, great little subplot there. And I've had realtors come to me and go, Mark, will you come teach at our office? And
I did that last week. Yeah.
Yeah, I know you did Berkshire Hathaway last week. And it was just to let clients know there's $35 trillion out there. And,
right.
And they're like, what? I don't have to go to Wells Fargo? No. So this is pretty cool. Okay, so Dylan and this client, they get going in on it. Now, here's where another little life story starts to play out, another subplot. My son kind of realizes, I need some help. I don't know how to float a floor. I need a little help hanging some drywall. in a prior life. And when I was going through college, I did a lot of that stuff. And this was a chance for me to kind of mentor my son. Can I go work on the project, Matt? I thought we said earlier you couldn't work on a project.
Yeah, absolutely.
Because?
You're right. No, your IRA is not in there. Your son's IRA is not in there. So
see, everybody? Got to look from who's the IRA. Now, could my client come work on it?
No. Yeah, his IRA is in the mix. Yeah.
Yeah. And so I think that's an important distinction. So now, from a side note, this worked out wonderfully from an IRA perspective. From a life perspective, guess who ended up inheriting this 20% deal in the LLC?
Oh, okay. The guy working it?
Yeah. AKA me. So my son's like, you want to buy me out? And I'm like, okay. I'm like, ugh. So he ended up moving out of this area, and he realized real estate wasn't for him. We had some good experiences out there working. Whenever you're working with family on a property, it is a neat experience, pouring cement and digging ditches. In fact, ooh, Corey, our producer here, did you get sucked into digging a ditch over there? I think that was one of your worst memories of your life.
Oh, that was the worst.
We had to bury the electrical, that trench. We had to,
It was 100 feet of trenching.
100 feet, 3 feet deep?
Yeah.
And you
100
can't,
feet trenching, and then it was rock.
all rock, and it was uphill and downhill, all right. So anyway, so Corey even got sucked into this project and anyway, but here's the good news. Okay. Now here's what's neat. This project is now worth over 200 grand. So the time and money in the project is going to turn out. We also realized we can turn this into a rental before we flip it. Let's do that for a little bit and play out this market that's running. So it's currently hasn't even sold yet. It's a rental. That's cool too. And the beauty of this deal is it's a fairly large lot. And so I've been working with a local CPA in that town who has connections to planning and zoning and the city council, and we're working on a lot line split. So I'm going to be able to split out a lot that can have a spec build on it, and I can sell that lot separate. I have the fix and flip, now worth over 200K. We're into it about 150, and we got renters in there right now. I think we could get 250. The market is so freaking strong right now. Everybody knows it's a buyer's market. I mean, a seller's market right now. So, but anyway, I thought, Matt, what would you add to that deal? I mean, just lessons learned. Anything that you'd say?
Yeah, I just think I like the lens of taking the other side of it of my IRA is not doing the deal, but the deal got funded by someone else's IRA. And for those that are fix and flippers, you might be on both sides of this sometimes. Sometimes your IRA is doing the deal. Sometimes you're doing the deal, but someone else's IRA has provided the financing on it. And so understanding the rules based on what role you're in is really important. If it's someone else's IRA that's just funded the deal and you're doing it personally or your own S Corp or LLC, cool, get more involved. You can be doing the drywall like Mark or, managing the property, going to the city council, whatever. That's all cool. But if you're over here where your IRA owns it, nope, you're not doing that. You're more hands off. You can tell people what to do, but you're not actually going in, digging a trench or a ditch or whatever. What's
the difference between a trench and a ditch?
I
think a ditch is wider.
Ditch is wider. Okay.
Yeah. Ditch means water's going down in it or something. A trench.
Okay. Yeah.
Yeah. Some of you may go, why didn't you just rent a trencher? They tried, too many rocks. They had to literally pickaxe, shovel 100 feet. I think it was good for Corey. It was a good character. It was a character building experience.
That's what they used to make like prisoners do.
Yeah.
Was that like cruel and unusual punishment right there?
What did you say about the trencher, Corey?
It literally broke the trencher.
Oh, it literally broke the trencher. So they said,
okay,
guess we're by hand. So
can you get a ditcher? Look at they don't. As you were using a trencher for a ditch job, what are you guys doing?
Corey, I think he's over here kind of huddled in the corner. I think there's some traumatic residual effects here. But I think another take on that whole story is there are so many variations. And I think that's what's exciting. And so I want to commend all of you for just listening to this podcast. Matt Sorensen is a real genius on this. I can't tell you how many times, I would say at least once a week, I call him, sometimes during a live broadcast, and go, dude, can we do this in a deal? And so I think having the law firm here, that acts as a sister company to Directed IRA is such a huge resource for many of you, and this podcast and the books. And so please come out to the summit. And I think there's so much money that can be made here tax-free. My YouTube video titled The $1 Million Roth IRA, it's the fundamental principle is that you can make more than a 6 or 8% mutual fund. And that's the key to building massive Roth IRAs. And so hats off to you people.
Yeah. So we hope for those of you that like to flip or want to, just know you can do it with an IRA. And one other strategy I want to throw out there is you can also partner multiple accounts into an LLC. We didn't mention this. Let's say you have your account, your spouse's account. You could put those into one LLC that goes and buys a property. It's called a multi-member Ira Llc. And a lot of times that's another way to avoid UDFI for IRAs, is just combine some of your cash you have in retirement accounts, even some personal cash, spouse's IRA, your IRA, friend's IRA. You can get some little partnerships together that can go and take down these deals without having to get debt or a hard money lender or anything like that. So just consider that as another option, and check out the video on multi-member IRA LLCs.
Also, I think another point we need to finish up with, which is always a nice ending to any show, is 50 Shades of Grey. Now, what goes on here? This is very important. Some people go, well, I want my, I'm going to bring this around, Matt. Have some faith.
Okay.
We're not going to get an E rating here today.
Yeah, just keep it PG, can you?
Okay.
All right.
Mr. Gray, and okay. Now, here's what we're going to do. Let's say I want my S Corp and my crew, and I want to go work on this project. And you say, well, let's say I joint venture, set up an LLC with someone, and I still want my IRA in the deal. Let's say between my IRA and myself, we own 49%. Now can I go do work on it? Even though my IRA's in the mix, I'm under 50%. What do you think, man?
Possible, but there's maybe 39 shades of gray, I would say. Because if you're below 10%, and I don't care, fine, But if you're between 10 and 49, now I'm concerned. What's the ownership stake of you or your IRA there?
It goes from light gray to dark gray, back, forth.
Yeah.
Yeah.
Yeah, the 49 is the one that kills me, and I always tell clients the 49% one is worse than 100% because it almost looks like you just intentionally tried to get around the rule. And you're thumbing your nose at the IRS. They'll chase it down for self-dealing, I would suspect. So be careful when you're trying to play both sides. Even when you're below 50%, just get a consult or make sure you're really educated on the risks on that. And like I said, if you're single-digit ownership with your IRA, let's say, and you want to go work on it, you're probably okay. You're probably okay, even if you're getting paid for it. There's some cases in the single digits where I just think it's like there's no self-dealing or anything unfair going on. You don't have enough control or ownership to really do something that would, that the IRS would be concerned about from a tax standpoint.
Yeah, and I think, these 39 shades of gray, there's all sorts of options, and you just can't be in the dominant position.
That's right.
Thank you. I was waiting for that moment. Is that okay?
Yeah, you were waiting for it.
Yeah.
So
I think that's going to get by the E rating. No one's going to be able to, there's no web crawler that's going to figure out that pun.
Yeah. Well done, sir. Well done.
Thank you. Yeah. For all of you kids in the car, you have no idea what I'm talking about. So that's okay. And if you're making your kids listen to the show in the car, if you're making your kids listen to this in the minivan on the way home from school, you need some help anyway. Maybe you're trying to, torture them. Yeah. We love you kids. Someday you'll self-direct your own IRA.
All right, everyone. Well, thanks for tuning in. Of course, prior episodes you can get at directedira.com/podcast. We've got almost 40 episodes now. If you want to see any of the video content, if you're just listening to this on your favorite podcast player, you can catch it at YouTube. You got to put up with Mark, and man, he's got a great light job studio look going. You can see me in my office with my dumpy setup and webcam, but
This is all I have to work with,
budget.
man.
We spent all the budget for the podcast in the Kohler studio, and this is what was left over here. So.
Hey, you know what? This is all I got to work with. I need all this work behind me to kind of enhance there's not much. So, folks, I do recommend the YouTube channel if you can. Lots of fun there. And please subscribe. Every Thursday, I go live at 4:00 on YouTube, answering questions from around the country. And today's topic is about real estate, ironically. So we're going to do a little bit of real estate, then I do open forum. A lot of times I can talk Matt Sorensen into coming. Are you going to come on live today? Can I get you in?
Not today. Sorry.
All right. Well,
Mark, this video isn't going to be live.
okay. All right. Corey's trying to say, this is not going to go live on Thursday. I get it. I'm just telling all the people that we've got different
So they know for the future.
Yeah, just know for yourself.
the schedule.
Thursday afternoons. We sometimes record the show on Thursday, even though it doesn't go live till Monday. But, you guys now have the inside info on that. And frankly, helps everyone. Hurts no one. It's good for the economy. you just want to end the show, don't you?
It's good for the economy. Helps everyone. Hurts nobody.
I think as long as you get the 3 points, it doesn't matter what order.
It's kind of a sequence,
They're kind of a
good
sequence.
For the economy. Yeah.
Okay.
Yeah. You
All
got to
right.
get it right.
So you start with good for the economy.
Yeah. Good for the economy. Helps everyone. Hurts nobody.
Okay. That's how you do it. Okay. I'll remember that. So everybody, there's your joke this weekend. So if you're at a dinner party and someone is kind of like, well, what's that about? You say, it's a good deal.
Yeah.
Good for the economy. Helps everyone. Hurts no one. And I think if you add the whisper to it, it really makes it a little more creepy, which is nice.
The creepy Biden whisper, I mean, that's part of the deal with that quote.
Yeah, you got the creepy Trump rants and you got the creepy Biden whispers. Either way, we're down the middle here. We insult people across the aisle. We don't play favorites.
Yeah.
Okay, everybody. Hey, thanks everybody for listening and watching. We love you. This is so fun. Get out there. Oh, and self-direct on. Is that your motto, Matt?
Yes. Yeah. Stay calm and self-direct on.
See you next week.